a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A risk for Sino-US relations. China defends its cooperation with Iran and warns against any disruption after the US threatened Tehran's economic partners. Another response to Washington's trade pressure. Canada set to announce a range of measures to protect its citizens from 50% US tariffs on certain goods. And growing criticism of Secretary Scott Bessent's bond buying plans. His mentor Stanley Druckenmiller publicly now calling it a mistake. Let's get a check on markets around the world. First off, Winnie Su is in Hong Kong for us. Winnie.
Yeah, good morning, Bonnie. Well, we did see Asian stocks fluctuating quite a bit today. Now the benchmark is trading in the green after erasing some of its earlier losses. It does seem like a bit of a calm before the storm, if I could say. We are still closely monitoring those moves in terms of the Iran sanctions as well as the trade tensions between the U.S. and Canada as well as U.S. and China. Well, we do see oil prices coming back down a bit, so perhaps that is also helping the overall rebound in the regional stocks, especially with Kospi index here trading ended in the green after having reversed as much as 4.3% of losses earlier today. Now flip a board, you take a look at one market that actually is still trading in the red and under some pressure, which is a Chinese market. We are seeing both offshore and onshore stocks in the red, and that is coming as the tech stocks still facing some pressure. When it comes to XPeng, it is down about 10%. We did see earnings missing estimate for the both second quarter earnings as well as the third quarter outlook. So that overall weighing on tech stocks in Hong Kong, with the gauge now trading at its lowest level in 7 weeks.
All right, a difficult week for tech stocks. Winnie, thank you so much. That's Winnie Su in Hong Kong. Europe, meanwhile, is choosing to look on the bright side. So we have the general stocks Europe 600 index up about 1/3% now. Broadly positive across the board. In London, we have the FTSE 100 up about 1/10%. This is mainly on lower oil prices, which we've been seeing now for a couple of days after oil hit a 2-week high. And then the euro, pretty stable right now, 116.68 versus the US dollar. It has been strengthening, though, all month as this debasement trade takes hold. So we do want to keep an eye on that. But let's move to the United States, because we've seen several days of declines for chip stocks. Yesterday, we were down more than 2.5% on the stocks. The NASDAQ end of the day down 1%. And we've been seeing days and days, 7 consecutive of them, of lower prices for Nvidia before earnings tomorrow. That's one of the catalysts for this week's trade. Before that, we are seeing a little bit of a rebound today for NASDAQ 100 futures. Not as much for S&P and for Russell 2000, which have been lagging the NASDAQ in the session, but we are seeing those in the green. So we'll see what Nvidia has to say. And then, of course, at the end of the week, we have Jackson Hole. And we have markets continuing to respond to the Treasury's moves. Now, to that point, today we have the most public excoriation that we've got yet of Scott Bessent's plans. Stanley Druckenmiller, noted billionaire hedge fund trader for decades now, worked with Soros and Bessent and has been very involved in sovereign markets and, of course, in FX markets, coming out and saying this is a mistake. The 30-year yield and that bond market is the only fiscal disciplinarian left that we have. And he has put all of his thoughts into the Wall Street Journal. Very unusual move for Stanley Druckenmiller, usually fairly private. So we have the 30-year yield, though, down about 3 basis points today. And as you can see, crude lower, gold just off a touch, but it's still high up there. And Bitcoin very near 80,000, which it did top. 82,800 and change is the next level that we are looking at. All right, let's get to some individual market movers now. For that, we'll go across to London and Chloe Melly.
Good morning, Bonnie. We're seeing chip stocks rebounding, finding a bit of a steadier footing ahead of those Nvidia earnings. Of course, Nvidia being this bellwether for the AI trade, and it seems that there is some enthusiasm in that sector ahead of those very important earnings. So very much green across the board there. Moving on to Dick's Sporting Goods, which is also in focus this morning ahead of the earnings, and investors are really looking for signs that the turnaround for Foot Locker is working, and it seems that there is some cautious optimism ahead of those earnings this morning. We're up just slightly in the green. And finally, over in London, Melrose Industries had some issue back in May with a manufacturing facility closing. Now it is saying that the operations will resume by the end of September, and clarified some of the costs around that closure. And that is really driving the stock this morning, reassuring investors, and we're up about 9% here in the UK.
All right, that is the top performer in the FTSE. Chloe, thank you so much. Chloe Melly there. Coming up, we're going to be speaking with Allen of Deutsche Bank. on what he's calling an unstable market equilibrium. Washington's latest plans to isolate Iran's economy hitting dozens of businesses in China and Hong Kong, putting potential further consequences in the spotlight. Beijing is Iran's main trading partner and the buyer of 90% of its oil. China earlier reiterating its opposition to the sanctions placed on dozens of Hong Kong and China-based entities. None of its major financial institutions, at least as of yet. Joining us now is Bloomberg's Jill Deesis in Hong Kong. So the Foreign Ministry a couple of hours ago, Jill, basically saying we're doing all of what we do with Iran in coordination with international norms. There's nothing wrong with this. We're going to continue to do so. That's a pretty strong response. Would it suggest that there's more to come if there are more sanctions placed on China institutions?
Yeah, look, Bonnie, I think at this point, we're still really waiting to see whether or not there's a really big hit here. I mean, you did have that language coming out of China's foreign ministry. I will say a lot of that is sort of reiterating things that we've heard from China before. So obviously, you know, they stand at the ready for any kind of a retaliation. But I mean, let's take a look at what Scott Bessent actually announced, right? You've got, you know, sanctions on these dozens of firms in China and Hong Kong, but you're looking at a lot of sort of smaller firms, the tech procurement kinds of, you know, aspects. I think, you know, when we're talking about what would really, really hit China, what would be a really, really aggressive move, despite, I will say, some pretty strong language coming from the U.S. Treasury Secretary here, I think what you'd have to see is, you know, sanctions on maybe a really large Chinese bank. We did hear some hints from Scott Bessent. He was pretty vague. He didn't mention anyone by name, that maybe there is something more potentially coming. But I think that kind of sanction or other types of secondary sanctions on China that would really hit them, you know, when it comes to, you know, that oil trade in particular. I mean, that I think is maybe a little bit too far of a bridge for Washington to cross here. But I do think that at this point, a lot of the retaliation, or sorry, a lot of the response that we've seen from the United States at this point is still fairly mild compared to, you know, the full toolbox here. It's still a big question as to whether or not Washington would actually want to go that far, though.
Well, and we know that China can create substitute entities pretty quickly for sanctioned entities if it needs to, right? But that wouldn't be the case if a major financial institution were to be sanctioned. Now, Scott Bessent has threatened it. China is obviously saying, don't undermine our relations with Iran, so it's not going to do anything proactively. Is Bessent boxing himself into a corner here? Will he have to sanction some kind of major China institution?
I mean, you've certainly heard a lot of rhetoric from the United States. You know that Donald Trump himself is very frustrated with how long this war has gone on and is looking for ways to inflict more economic pain on Tehran specifically. I do think, though, that the limiting factor when it comes to China is the fact that we've got this upcoming summit between Xi Jinping and Donald Trump that's supposed to be happening in Washington, D.C. in just about a month's time. And I mean, you know, there's a lot of questions over how much, you know, the United States would actually want to jeopardize that meeting, this relationship between the world's two economic superpowers. You've got, you know, a lot of questions over the status of maybe the trade truce between the United States and China, which was signed, you know, just under about a year ago. You know, you've got all of these sort of considerations going into this meeting in Washington, D.C. next month. I mean, does the United States actually want to jeopardize a lot of that? I think that's a really, really valuable question here to ask. But at the same time, you know, if you're the United States, if you're Donald Trump, you want this war to end before the U.S. midterms in November. It's becoming deeply unpopular with the United States, the American public. And, you know, it puts the United States in really a bind here.
Well, to your point there, Jill, that one-year trade truce is set to expire November 10th. And we're also hearing reporting that the U.S. is set to impose a 7.5% tariff on Chinese goods. This is the 301 tariffs. We're waiting on results from the investigation, but they should come soon-ish. Is this all leverage before the Trump-Xi summit?
Yeah, I think, I mean, this is an interesting one. So this is people familiar with the matter telling us that they're looking at imposing the 7.5% tariff as it relates to some of their concerns over China, over capacity manufacturing. This is related to, again, as you mentioned, those Section 301 tariffs. I think this is really part of the Trump administration trying to rebuild elements of its tariff regime that was struck down by the U.S. Supreme Court. I think if you were to look at the calculations in terms of what's being considered here, we're not really looking at an implementation of tariffs that would be above, you know, a threshold acceptable to Beijing, at least when it comes to upholding the status of that trade truce. So we'll see what ultimately happens there, whether it's some posturing ahead of that summit. But yeah, I'm not sure that it's going to move the needle substantially at this point.
All right, Jill, thank you so much. Bloomberg's Jill Deesis for us in Hong Kong. Here in the Americas, Canada is set to announce a range of measures to protect its workers and businesses in response to 50% US tariffs on $20 billion of Canada's annual exports. A press conference expected at around 11 a.m. New York time. Let's get more with Bloomberg's Brendan Murray. So we're supposed to hear what Canada is going to do for its own citizens. Brendan, will there be any repercussions for US citizens in what's announced today?
Yeah, it sounds like what we're going to get are things like additional jobless benefits and support, maybe loan support for businesses to help them weather this trade storm that Canadian businesses are about to go through. But what we've really seen over the past 24 hours is a real uptick in the rhetoric and the tone and the trust level between Ottawa and Washington. This is the result of the breakdown in the talks that headed into the weekend, and so we've seen President Trump and Prime Minister Carney lob insults at each other, and this really isn't an environment that's conducive for both sides coming back to the negotiating table anytime soon. That said, the amount of economic activity that's hit by these tariffs is still relatively small. The escalatory talk would hit more economic activity, but at the moment we're really just in a war of words rather than one where supply chains would be severely impacted by tariffs on a broad scale.
So, according to our reporting, Howard Lutnick really collapsed the talks sort of last minute. He was unhappy with any deal for metals producers. But what does this change for those producers, Brendan?
Yeah, I mean, what we have inside the administration are the hawks and the advisors who are not so hawkish about the whole reshoring issue. And as you've mentioned, we're coming up on 2 months before the midterms, and there are some key battleground states where members of Congress on the Republican side don't want to lose those seats. And so what they're trying to appeal to here is that the administration is bringing jobs home, reshoring production, and the White House is looking at those production lines in Canada and saying, Canada's got something that we want, and we are going to put tariffs on Canadian imports until those incentives realign for auto manufacturers to make cars in the U.S. and trucks. So what we're seeing is part economic posturing and part political posturing. Right now, Canada thinks it's got some leverage on President Trump because a trade war against Canada is not as popular as a trade war against China, and we'll see how that plays out in some of the border states in the weeks ahead.
To your point about it being a political situation as well, Trump basically endorsing somebody for the Oklahoma's governor's race, using the planned aluminum plant there as leverage really for his endorsement. That's the thing though, are there aluminum plants planned all over the country, Brendan? Or how are we supposed to come up with the aluminum if there isn't enough aluminum in the US?
Yeah, exactly. I mean, the investment pledges have been made in some cases, but it takes years to build these kind of facilities, and it takes a lot of power, and that's why Canada has the big aluminum capacity, is because of the hydropower that it provides. And so these are the things that are not going to be resolved with some tariff threats over the next few months. But ultimately, the Trump administration is trying to make this case that they are pressuring the U.S.'s main trading partners with tariffs to try to reshore some of those national security related industries that they're trying to bring back to the U.S.
All right, Brendan, thank you so much. We'll hear more at 11 a.m. at that news conference. That is Brendan Murray, our trade czar. Now to other top stories trending on the terminal this morning. Stanley Druckenmiller calling Treasury Secretary Scott Bessent's plan to suspend billions buying back U.S. bonds a mistake. In a Wall Street Journal op-ed, Drunckenmiller argues that policymakers should let the market do its job and said governments defending prices against fundamentals always lose. Drunckenmiller mentored Treasury Secretary Bessent in his early career as a hedge fund trader. Volkswagen Labour representatives warned that the automaker's planned cuts could eventually affect as many as 140,000 jobs. Management has outlined cuts that could eliminate as many as 100,000 positions. Union officials say another 40,000 could go if certain factories close. Volkswagen CEO Oliver Blume is taking his restructuring pitch to workers at the company's main factory today. Bitcoin has climbed above 80,000 for the first time since mid-May, extending that sharp rebound. The cryptocurrency rallied more than 23% last week, its biggest weekly rally in about 3 years. Coming up, a deep dive on how the closure of the Strait of Hormuz could reshape supply chains and energy markets. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. The closure of the Strait of Hormuz during the war with Iran has exposed the risks of countries and economies relying on one of the world's most important energy choke points. However, the market has proved more resilient than many expected. Bloomberg Intelligence examines how the world has adapted and whether it marks a turning point for global supply chains. Will Hayers of Bloomberg Intelligence joins us now for more. So, Will, have we seen peak Hormuz now?
So peak Hormuz we are viewing in the terms of dependence on Hormuz. We are seeing a very quick movement and adjustments from the Gulf states and companies to diversify and de-risk from the Strait. And this is coming primarily via pipeline expansions, storage facilities, and new port construction in and around the Strait and to bypass the dangerous waterway now.
Is it still necessary? I mean, all these choke points that we have around the world, and now we're finding ways around them. The UAE has a workaround, and Aramco is now operating a pipeline running across Saudi Arabia. If there were the possibilities for those before, then why did it take so long?
Well, so it's really a system of de-risking. So we're looking at a multifaceted approach to reducing the risk of that waterway. We're seeing some of that being within the Strait itself. The U.S. Navy is conducting some convoy escorts. And to varying success, we have seen reports of up to 10 million barrels per day being achieved from some U.S. government officials. We think that's probably a bit lower, but it will really be a multifaceted approach from pipelines, from some vessels transit, from some demand destruction, and a little bit of production increases outside of the Gulf.
We're basically pretty much through the quarter for the energy majors. What would you say would be a good summary of their comments about Hormuz, the state of Hormuz, and is there a consensus on strategy for dealing with it?
So the consensus from 2Q comments from the European energy majors was that they expect a intermittent Hormuz transits moving forward, and we think this is a pretty reasonable approach. It's not going to be anywhere close to where we were pre-war at 20 million barrels per day. We think somewhere around 5 million barrels per day. You might have some days that it pops up a little bit more, but their approach is going to be one of diligence and resiliency and discipline. They have removed all 3Q operational guidance from the Gulf. However, they're still doing very well in this environment. The operational impact that they sustained, this is Shell, BP, Total, really pales in comparison to the commodity price capture that they saw in 2Q, the trading gains that they made, which are very high, and of course the extraordinary refining margins that are flowing from the disruption of the downstream facilities within the Gulf.
All right, well, it is a fantastic report from Bloomberg Intelligence. I would urge everybody to read it, the current state of play, how Gulf countries have been adapting, increasing bypass capacity and so on to the Strait of Hormuz. That is Will Hayers of Bloomberg Intelligence. Coming up, UK Prime Minister Andy Burnham planning for a trip to Washington. A look at what's making headlines in your front page news next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, the Financial Times reporting U.S. grain farmers in the Corn Belt are facing their worst crisis in 40 years as the Iran war sends costs of inputs from diesel to fertilizer spiraling. Heartland farmers already struggling after years of low grain prices. This pain all coming ahead of midterms that will determine control of Congress. Next up, the Washington Post on the Supreme Court easing a path for an executive order from President Trump that would impose sweeping new restrictions on mail-in balloting. The Post says it could inject fresh uncertainty into the already high-stakes midterms. The case now returns to the lower courts. And Bloomberg reporting UK Prime Minister Andy Burnham plans to travel to the US next month to lobby President Trump to let Ukraine access some of its Patriot air defense missile stocks ahead of winter. Burnham told Bloomberg that European leaders are considering holding another Coalition of the Willing meeting around the UN General Assembly. Let's take a look at markets. We are seeing Nasdaq futures pointed higher, the 30-year yield lower, but more criticism today from Stanley Druckenmiller, no less, in the Wall Street Journal of Scott Bessent's plans. Gold holding on to gains for the most part, but just off its highs. All right, coming up, we're going to speak about all this to Henry Allen of Deutsche Bank. It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A risk for Sino-US relations. China defends its cooperation with Iran and warns against any disruption after the US threatened Tehran's economic partners. Another response to Washington's trade pressure. Canada set to announce a range of measures to protect its citizens from 50% US tariffs. And growing criticism of Secretary Scott Bessent's bond buying plans. His mentor Stanley Druckenmiller publicly calling it all a mistake. Let's take a look at futures. Nasdaq 100 futures bouncing right back. We've had 7 days of declines for Nvidia, but it looks like the tide might be turning, at least on sentiment for tech stocks after a really down session yesterday for chips, with Nasdaq 100 futures pointed that much higher. It's across the board, though. S&P futures, Russell 2000 futures also rebounding. Let's take a look at yields, though. An absolute slap in the face for Scott Bessent today with a public op-ed in the Wall Street Journal by Stanley Druckenmiller suggesting that everything that Scott Bessent is doing is wrong-footed. Now, we do have the 30-year yield below 521 right now, down another basis point, down about 5 basis points from this time yesterday morning. Take a look at the 2-year yield, though, which is where everybody will be looking before we get Fed Chair Warsh's comments at Jackson Hole. Is at 422 and change. Now, we're also getting some positive sentiment feed through from crude prices being lower, down about 3%. Even Brent is below $90. But gold is still up there above $4,600. And Bitcoin topped $80,000 as this potentially debasement trade continues. Let's get to some individual market movers now with Chloe Melly.
Good morning, Vonnie. It is green across the screen for those chip stocks after some recent weakness. This is ahead of those Nvidia earnings, of course, very important given that the company really is a bellwether for this AI trade. And it seems that there is some optimism, some enthusiasm there around this AI sector. And we are seeing the likes of Intel, Micron and AMD also quite firmly in the green this morning. Moving on to Dick's Sporting Goods, which is also in focus ahead of earnings today. We had seen the shares slightly up. Now they are slightly down. The real focus for investors is going to be around the turnaround for Foot Locker. So there seems to be a little bit of uncertainty around what the company is going to report. And finally, let's go over to Poland, where CD Projekt, the video game maker, is down quite significantly this morning. The worst performer on the European benchmark, down about 6% after delaying the release of its latest game, The Witcher 4. And so we are seeing that really weigh on the stock with that delay.
All right, Chloe, thank you so much. Chloe Melly there in London. Billionaire investor and the early mentor of Treasury Secretary Scott Bessent, Stan Druckenmiller, saying his former pupil has made a mistake with his bond buying strategy. Druckenmiller writing in the Wall Street Journal, markets aggregate information no committee possesses, and prices are how that information reaches decision makers. The long-term Treasury yield is the most important price in the world. It is also the only fiscal disciplinarian the US has left. Every basis point of artificial yield suppression is a subsidy to procrastination. Joining us now is Henry Allen, macro strategist at Deutsche Bank. Wow, that is a slap in the face, Henry. Each sentence that I read there, and I would suggest there's even a veiled criticism of the Warsh Fed here too, suggesting that you don't need to tell markets that they need to make up their own mind about the data. Markets are the aggregators of information that tell you what to do. What are we to make of this op-ed today, Henry, and the idea that Scott Bessent's plans are just all wrong?
Well, it's certainly a striking piece. And in terms of what the Treasury have done, clearly there are always risks if you're moving in that kind of direction of almost like financial repression, really. And we've seen, obviously, even as long-term Treasury yields came down, there was a reaction in the price of other assets. We saw, for instance, the dollar depreciate. We saw investors move into gold at the same time as well. So it's clear that investors are concerned about financial repression. But at the same time, to be honest, I don't think you're in a world of debasement. I think that there's been too much of a narrative that there is this debasement trade that's back. But much as gold prices have risen, you're not seeing a reaction in long-term inflation swaps at the same time. If people truly believe that some debasement scenario was on the cards where the Treasury were going to inflate away the debt effectively, you would start to see long-term inflation expectations, particularly at like the 30-year horizon, move higher. That's something we haven't seen at all so far.
And as Bessent himself said, there hasn't been a single bond bought yet, right? This has just been announced. So the whole way this is playing out is really fascinating. If we take a look ahead to Jackson Hole, you're saying that there won't be that much that will come out of Jackson Hole. What would be the best case scenario for the market?
Well, I think the market is kind of craving certainty at the moment in the sense that Walsh has clearly steered away from forward guidance. He's been clear that he thinks there are downsides to that. So we're seeing more volatility introduced, whereby we're going into the next meeting with markets, just like in July, very unsure what the Fed are going to do. So that's introduced a regime with higher vol, and we know that more vol on the rate side has traditionally also led to more vol on the equity side as well. So from a market point of view, I think what a lot of people would love is the kind of steer that Powell gave us in the last couple of years, where he implicitly signaled that rate cuts were ahead. But given Walsh's very much, decried forward guidance, says how it locks the Fed into actions that might not be appropriate given later data, I think it's unlikely we're going to get that.
So with that and the core PCE, which we already sort of have an idea of how it's going to come in this week, that's two major risk catalysts out of the way, Henry. And, we're in a low volume environment. But what happens to the markets then next week? Can we settle in and is it plain sailing for a little while then?
Well, I think it all depends how the incoming data comes in, because when you get into September, the kind of back to school season, we still have another CPI print and another US jobs report on the horizon. Some of the recent data has been on the more dovish side, but clearly, market pricing is still in the balance. So anything that risked a hawkish lean, I think would see that pricing start to tick up again. And one thing that we've pointed out is the risks definitely lie in the hawkish direction. If you look at the starting conditions for where the US economy is right now, in particular the fact that CPI and PCE inflation are both above 3%. In the past, that's often been consistent with 100, 150 bips of hikes when you enter a hiking cycle. So it's clear that markets risk being caught off guard on the hawkish end, given we're in an environment of above target inflation, very robust growth data, very strong earnings, and very accommodative financial conditions right now.
Could we have some kind of a tantrum either in the bond market or elsewhere? Christina Hooper of Man Group also saying today that, Washington becoming adversarial with its closest allies, levying tariffs and so on, with everything else that's going on, the US is just becoming a little bit less attractive and maybe even more unstable.
So, we saw those similar themes around Liberation Day last year, where you had not quite capital flight, but you had a situation where US equities, bonds and the currency, the dollar, were all falling at once. And certainly what we're seeing is more policy uncertainty being introduced. But that's been a theme throughout the second Trump administration. That's not a new theme that has just burst onto the scene. So, yes, tools like the Treasury buyback operation were definitely unexpected, but I don't think this is the start of some big sea change in economic policy making in the United States.
You do think the current equilibrium is inherently unstable, though, and you're sort of talking mainly, I guess, about the macro situation in the sense of if growth remains strong, then risk assets remain buoyant, and that creates its own problems, and then vice versa. If growth doesn't remain strong, that also presents a set of problems. Which is the more likely outcome?
I think the main risk is, fortunately, on the upside, where growth remains strong, earnings have been very buoyant, but the byproduct of that, if we see this buoyancy in markets, this strength for risk assets, accommodative financial conditions, is that inherently puts pressure on the rate side, which is kind of what we've been seeing a bit more in the last week or so, where investors are upgrading their future growth expectations. Companies, including in AI sectors, feel more confident to borrow. That increases bond supply, and you see that upward pressure on yields. You see that pressure on the Fed to hike. And we saw in the last hiking cycle in 22-23 how markets were caught off guard repeatedly by the extent of their hawkishness, and I think that's very much a risk again this time.
What about the US dollar weakening? I mean, we've seen about a percentage point of weakening versus the euro. It's definitely not anything extraordinary, by historical standards, but there is a signal being put out there by dollar investors and traders, right?
For sure. And if, effectively the US Treasury are buying back long-end treasuries, pushing yields down, what you're seeing for foreign investors, who obviously buy a lot of US Treasuries, is effectively the FX adjusted price of those is falling anyway. So even as treasuries rally with the yield falling, what you're seeing then is the dollar fall as well. So in FX adjusted terms, that adjustment is taking place through the currency rather than through the price of the bond itself. So it's always hard, a bit like that article was saying, it's always hard to kind of beat the market because there'll be some other way in which the adjustment happens anyway. Yeah,
there's no bully like the bond market, right? Henry, what is the trade then? If all of what you just said comes to pass, even in the most benign scenario, what's the best way to take advantage of that?
I think the main risk is that growth remains strong. Well, clearly that's a good risk to have, but I think then the risk is that the Fed and other central banks are forced into a more hawkish hiking cycle than anticipated. So I think the risks are very much that they do end up hiking at the next meeting in September. We saw how negative the reaction in markets was to Walsh's last press conference, where he struggled to explain why the Fed hadn't hiked. I think the Fed won't want a repeat of that. So given the incoming data, given above target inflation, given that growth and earnings remain very strong, I think the risk is very much that the Fed are led into a more hawkish tightening cycle.
All right, Henry, thank you so much for joining us this morning. That is Henry Allen of Deutsche Bank. Now to other top stories trending on the terminal this morning. The SEC has sent subpoenas to major Wall Street banks regarding the hedge fund situational awareness. According to sources, the information being sought is related to the hedge fund's trading activity. The spokesperson for the SEC declined to comment. The Trump administration is proposing a regulatory process that would charge roughly $103,000 for each candidate a company sponsors for a new H-1B visa. The move comes after a federal court struck down in June an attempt to put a $100,000 fee on those visas. Smart ring maker Oura and some of its backers are looking to raise as much as $3 billion in a US IPO. According to sources, the offering could come as soon as September. It would value Oura at more than $16 billion. The company filed confidentially for an IPO in May. Coming up, we know the rules of the game. A stark warning from Iran after the US threatens its economic partners. We'll get the latest next. This is Bloomberg.
Today, we are launching Operation Economic Outcast to foreclose every other option available to the Iranian regime. Treasury has mapped every node, every facilitator, and every network that Iran has used to smuggle oil and evade sanctions. Beginning today, the actions of Treasury and other agencies will tighten the noose and block every potential source of revenue that funds the IRGC and the evil Iranian regime.
That was US Treasury Secretary Scott Bessent. Well, Iran's economy minister hitting back on those threats on state TV, saying, quote, "The US wants to launch an economic terrorist attack against us, but we have our own tools and we know the rules of this game. This time, they should not think that our approach is purely defensive. They should also expect an attack from our side." Joining us from Dubai is Bloomberg's Abir Abu Omar. Little cryptic, Abir, what might this possibly mean?
Yeah, good morning, Vonnie. Unclear for the time being, but I mean, everyone feared a conclusion where if the U.S. were to establish those economic isolation plans that were laid out in Scott Bessent's press conference yesterday, that Iran may retaliate in some fashion. Now, there were some analysts that were saying that if Iran was essentially suffocated by this economic pressure, that it may retaliate against Gulf countries, taking us back to a scenario similar to what we saw at the end of February this year, of course, when this war started. But for the time being, you mentioned that Iran's economy minister comments. He also said that Iran is fully prepared to any scenario that the U.S. has when it comes to those sanctions. He said, actually, he gave a time frame. He said about 2 years, Iran can withstand those economic sanctions. And the sanctions that Scott Bessent had announced yesterday, of course, Vonnie, were widely expected. We widely expected secondary sanctions against Iran for countries that continue to do business, financial, trade transactions with it, namely, of course, China, despite the fact that Bessent did not name China. And we have reported, of course, that some of the sanctions may catch up with some Hong Kong-listed companies, but the U.S., of course, fell short from announcing any sanctions on major financial institutions within China that facilitate those trades. But then let's just remember that at the heart of all of this, we don't have clarity on what exactly those secondary sanctions will catch up with. We have an aggressive response from Iran. And then the issue on the ground remains, and that is the Strait of Hormuz. Both countries still have a chokehold over it. The U.S. maintains its U.S. naval blockade, and Iran still pauses that threat on vessels that make their way through the Strait of Hormuz. And so let's just remember that despite oil prices not moving, or moving downward actually after that press conference when it comes to Brent crude, at the heart of the whole issue is the lack of movement in the Strait of Hormuz, that if it lasts for a while, will create more elevation in these oil and energy levels. And so that is the situation that is most pressing for the time being, aside from the back and forth remarks. And then the latest we have, and finally what we have, is the Pakistan Army chief was in Tehran, and there is a statement from some Iranian state media suggesting that there may be a fruitful conclusion to that visit. We don't know what exactly that means. They said wait for more details soon. So, of course, we'll watch out for that development and update as soon as it comes, if it comes.
Well, and of course, Abir, just on these potential secondary sanctions, we had China's foreign ministry saying earlier that it conducts Iran cooperation within an international framework and that its cooperation with Iran shouldn't be undermined. Is Iran quite confident? And I know you can't see inside any administration, but is there a quiet confidence there that China needs Iran, needs its exports, and no matter what the US does, there will be some kind of workaround for Iran?
Perhaps that's where the confidence in the Iranian statement comes from, Vani. Let's again remember that China purchases about 90% of Iranian crude exports. And then you have the foreign ministry spokesperson in China saying that both countries operate within an international framework that does not essentially take any side, or that kind of ignores the U.S. And that, so you have from the Chinese side some pretty adamant statements about what looks like the fact that they will continue this relationship with Iran. And then we have to also bear in mind that the U.S. response to all of this came a little bit shorter from what analysts had been expecting in the lead up to it. Again, Scott Bessent did not name any country. He actually refused to name China when asked about it. And so perhaps there's a little bit of confidence in that statement. And then when you see what the narrative is from the Iranian side, it maintains that it will continue to do business as usual. And then it maintains that those crude exports will continue. But again, the situation on the ground, there is the reality, and there is a distinction to be made here. The situation on the ground for the time being is the fact that Iran's exports of oil have come to a near halt because of that U.S. blockade. So it remains to be seen.
All right. With the latest, as always, we have Bloomberg's Abir Abu Omar. Thank you. In Germany, Volkswagen CEO Oliver Blume telling thousands of workers earlier that half the firm's additional job cuts are going to need to happen within Germany. Bloomberg's Will Wilkes joins us now. It's a fascinating story. Oliver Blume trying to turn around Volkswagen as CEO, and this could now mean up to 140,000 job cuts. But he can't just order them, Will. What is he supposed to do? He has to get, leaders on board, Lower Saxony leaders and so on.
Yeah, exactly, Bonnie. He's not able just to order job cuts. Under German corporate law, the supervisory board of a company has to sign off on major strategic decisions, and on the Volkswagen board, the union and, as you say, Lower Saxony effectively have a blocking block where they can kind of frustrate Blume's plans. And they've just had this meeting, which is finished around an hour ago, and what seems to be coming out is there's a lot of heated words. The Labour chief is saying trust in Blume has been damaged. Blume is saying we have to press ahead with cost cuts. But there does seem to be potentially some landing ground around voluntary redundancies and finding alternative plans for the plants in question.
Yeah, it's fascinating because Volkswagen operating at a 30% cost disadvantage, let's say, to its rivals if this doesn't happen. I mean, even if this does happen, Will, and I don't know how you operate in the meantime, how is it going to get back into any kind of shape competition-wise? Yeah,
Volkswagen's got a difficult few years, which the union leaders are also pointing out. The idea that Volkswagen can hit margins of 8 to 10%. The union leader called Cloud Cuckoo Land thinking. Volkswagen, is facing US tariffs. It's got competition from new Chinese manufacturers in Europe, and it's also got declining sales in China. So it looks like for the next few years, Volkswagen, and as with many other global automakers, it's not just Volkswagen that faces these challenges. It's going to be very difficult for them to lift margins substantially. But Bloomberg said it's urgent. We have to try. We need to push ahead with these cost cuts.
So at what point do we start seeing people calling for the German government to step in some way? And, what would that look like? Because it's clear Volkswagen can't continue, if it wants to be a global player in the future, it can't continue with this number of workers, right? And also the family is pushing for the cuts also because they want to maximize their dividends, and they haven't been doing that.
Yeah, well, it looks like the family has quite a major problem. These are the Porsche and Piech families that are Volkswagen's largest private shareholder. We've seen that the value of their holding is declining. They're under a lot of financial pressure. And I think more for workers and maybe more for the German state, this is an urgent problem for them. And that's why you're seeing kind of a pressure from them to Bloomberg to crack on with the program. I think the German state is already part of Volkswagen through Lower Saxony, and what the German state wants is the best possible outcome for jobs. Obviously, German politics is very heated up at the moment. There's a regional election coming up where the far right might make a major breakthrough. And what the German government really wants to see is solutions found for workers that does not kind of heat up politics anymore.
All right, well, it sounds like a lot of cobwebs right there. William Wilkes, thank you so much. Fantastic story about Volkswagen. All right, coming up, the Treasury auction and Fed speak on deck. We'll have your day ahead next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. We do have some more retail earnings. We get Dick's Sporting Goods before the bell. And then we get some Fed speak. Richmond Fed President Tom Barkin speaking at 8 a.m. and also 4 p.m. Eastern Time. And there's a U.S. Treasury auction. The U.S. will auction $69 billion worth of 2-year notes at 1 p.m. Eastern. This is your macro picture going into the Wednesday session. Let's look at the 30-year yield. We are down another couple of basis points. We're actually below 520 now, though. All the conversation today around the water cooler likely to be about that Stanley Druckenmiller op-ed in the Wall Street Journal, though, where he basically tells Scott Bessent to respect the bond market for what it is and the signals that it's giving you. This is it for Bloomberg Brief. Surveillance is next.